You always wonder what would happen if you could get two really smart, seasoned investors in a room and force them to agree on a list of stocks to buy and hold for the long haul. Well, that's exactly what we're going to break down today. So what happens when you really put their conviction to the test? Let's find out. So, what's the big question here? It's pretty straightforward, but the answer? Not so much. In a market that's just filled with constant noise and distractions, which companies really have the chops to be true long-term winners? This is all about finding those high conviction picks you can feel good about. To get to the bottom of this, we're looking at a challenge between two pros. On one side, you've got Joseph Hogue, a chartered financial analyst, and on the other, Brian from the channel Business with Brian, who retired early from giants like Amazon and Target. So you've got two very different paths to success, but they share one goal: find the absolute best long-term investments. And here's the catch, the rules of the game. It's not enough for just one of them to like a stock. Nope. To make the final definitive list, they both have to agree it's a must-buy. One person pitches, and the other gets to say yay or nay. Let's see which stocks can actually survive that kind of scrutiny. All right, so after all the back and forth, which companies actually made it through? Let's jump right into the 5 stocks that got a unanimous yes from both experts. The very first pick to get the green light was Broadcom. And this wasn't even a debate. It was called a softball pitch because the agreement was so instant. So what makes Broadcom such an obvious choice for both of them? Well, this slide pretty much lays it all out. Broadcom is a monster in the AI data center world, designing custom chips for all the big players. And the recent acquisition of VMware, it's already working wonders, pushing their operating margins to an insane 67%. And get this, its PEG ratio is under 1.0. For investors, that's often a blinking sign that a stock's price might actually be pretty reasonable given its massive growth prospects. It might still be a bargain. Next up, we've got a giant in a sector that has become, let's face it, totally non-negotiable for any business: cybersecurity. The second unanimous pick is Palo Alto Networks. Just think about it for a second. In today's world, what's one of the very last things a company is going to cut from its budget? Cybersecurity. With the threat of ransomware attacks, protection is a must-have, not a nice-to-have. Palo Alto is the top dog in critical growth areas like cloud and SASE security. And here's the real kicker. Unlike a lot of its high-flying competitors, it's actually profitable. That makes it a solid growth at a reasonable price play in a super important industry. Okay, moving out of the pure tech zone, our third stock is a name everybody knows. But the reasons it's a growth stock now might actually surprise you. Let's talk about Walmart. See, this isn't your parents' Walmart anymore. They're pulling pages straight from the Amazon playbook, pushing their own high-margin private brands like Great Value. Their buyout of Vizio? That's a brilliant move to turn millions of TV screens into a giant advertising business, all while their e-commerce is still growing at a really strong double-digit pace. This is a classic category killer that's found a whole new set of ways to grow. And hey, speaking of category killers, you had to know this one was coming, right? It's really no surprise that the fourth stock both experts immediately agreed on was, of course, Amazon. The big story with Amazon right now is that it's hitting the accelerator again. Its massive cloud division, AWS, is seeing a huge resurgence as companies flock back to the big cloud providers, the so-called hyperscalers, to power their AI ambitions. Their operating income has just exploded, and just like we saw with Walmart, advertising is now one of its fastest growing and most profitable businesses. All the signs are pointing to Amazon being ready for its next major leg up. And for the final stock that got the double thumbs up, I mean, come on. If you're talking about AI and the future, there's one name you just absolutely cannot ignore. The fifth pick is, of course, NVIDIA. Seriously, if you ever want to see what pure, raw market dominance looks like in a single picture, this is it. For every dollar in sales, NVIDIA turns an incredible 63 cents into operating profit. Its closest rival, AMD, just 10 cents. That massive gap isn't a fluke. It's what happens when you have a product everyone needs. It means they have the power to basically charge whatever they want for their GPUs. Okay, so we've seen the winners. But sometimes the most valuable lessons come from looking at what didn't make the cut. Understanding the disagreements is just as important, if not more so. The first major disagreement was over a company called Nebis, which is in the AI infrastructure space. The bull case was pretty compelling. You've got explosive growth and a tight partnership with NVIDIA. But the bear case raised some huge red flags about its whole business model, which is basically leasing out computing power. The fear is that once giants like Amazon and Microsoft fully build out their own AI infrastructure, they'll just cut out the middleman, leaving companies like Nevis in the dust. And this quote from Joseph really sealed the deal on the rejection. He basically said, hey, we've seen this movie before. He compared it to the computer leasing companies back in the 80s and 90s. They were super vulnerable to technology getting better, and many ended up stuck with tons of obsolete equipment they'd bought with debt. That historical echo was just too risky to ignore. The next big debate was over SoundHound AI, and this was a classic battle. On one hand, you have this massive, almost unbelievable potential in a $160 billion market with some really cool tech. But on the other hand, you look at the financials and yikes, the company is just burning through cash. It's not clear how strong its competitive advantage is, and its stock is trading at a sky-high valuation. For Brian, the risk just wasn't worth the potential reward. Okay, so let's put it all together. After seeing what got approved and what got rejected, what are the big lessons we should be taking away from all this? So here it is, the final vetted list. And when you look at them all together, you start to see a theme, right? They're all dominant, profitable leaders, true category killers in markets that are essential and growing. From the nuts and bolts of the AI revolution to cybersecurity and retail, these 5 companies represent that perfect blend of established power and very clear paths to future growth. But honestly, the biggest lesson here might not even be the buy list itself. It's understanding the thoughtful reasons for saying no to Nebius and SoundHound. Things like risky business models, burning through cash, and weak competitive advantages. Knowing what to avoid is an absolutely critical skill for any investor. And that really leaves us with one final question, and this one is for you to think about. The stocks that got rejected were big swings for the fences, bets on high-risk, game-changing innovation. The stocks that made the list were bets on profitable, established market leaders. So after seeing the arguments, which philosophy fits you better? Where do you feel more comfortable putting your money?